Investors rotated into safe havens during the latest session, boosting utilities by 1.8% even as tech weakness dragged broader market indexes lower. The VanEck Semiconductor ETF gained 0.5% with unrated moat durability. Enterprise infrastructure demand for the upcoming Nvidia Blackwell graphics architecture serves as the core catalyst behind this 0.5% shift. Accelerated capital deployment toward high-density AI compute nodes continues strengthening structural hardware fundamentals across major fabrication partners. Our full teardown reveals how critical component supply constraints directly impact upcoming margin expansion. SMH gained 0.48% to reach $586.91. Mainstream narratives claim this daily move represents simple market noise ahead of upcoming tech earnings. The actual hardware data proves capital is pricing in massive AI capital expenditure infrastructure cycles. Nvidia represents 17.8% of this total fund. Its graphics processors remain the core hardware engine, driving enterprise generative AI training workloads. Taiwan Semiconductor commands 9.2% of net asset value. TSMC fabricates virtually every advanced accelerator die rolling off silicon foundry lines. Micron Technology holds a 5.8% weight inside the balance sheet. High-bandwidth memory chips from Micron eliminate critical memory bandwidth bottlenecks in server clusters. Samsung recently began mass production of its PM1763 SSD optimized for next-generation AI platforms. That storage deployment reinforces the relentless hardware demand cycle underneath these core fund holdings. The short-term technical trend remains strictly bullish with the moving average 20 aligned above the 50. Meanwhile, the relative strength index sits at a balanced 41.9. This concentrated weighting in dominant semiconductor foundries and designers creates concentrated systemic execution risk. Federal funds rates at 3.63% keep capital borrowing costs elevated across the sector. Any hardware production delay or export friction at these top holdings directly impacts nearly a third of the portfolio. The lab views this setup as a targeted pure-play vehicle on silicon physical infrastructure. Open the hood on the VanEck Semiconductor ETF. The largest single dragging. Intel at minus 2.7%, carrying 5% of the fund. VanEck built SMH with an undisclosed expense ratio and unlisted asset under management data in current tracking systems. Fund marketing promises broad semiconductor industry exposure. The actual portfolio mechanics tell a drastically different, highly concentrated story. The top 5 holdings control 43.9% of the entire fund allocation. Nvidia leads at 17.8%, followed by Taiwan Semiconductor at 9.2%. Micron Technology sits at 5.8%, Applied Materials at 5.7%, and AMD at 5.4%. This structural weighting is not a diversified broad market basket. It operates as a heavy momentum vehicle anchored to frontline silicon manufacturing and architecture. Peer comparisons highlight this precise architectural tilt over recent trading cycles. Over the past month, competitor index SOXX dropped 7.9%, lagging SMH by 2.3 percentage points. Equal-weighted competitor XSD fell 12.2%, trailing SMH by 6.6 percentage points. SMH outperformed both direct peers due to its heavy weighting in market-leading megacap chipmakers. Year-to-date returns stand at 8,230.3%, far outstripping its 3-year average gain of 56.7%. Consumer price index inflation sits at 0.6% annually, while federal funds rates remain at 3.63%. The lab evaluates SMH as an aggressively optimized, front-heavy vehicle built to capture megacap hardware upside. The VanEck Semiconductor ETF is trading at a 0.433% premium to NAV, and that's the first red flag. Premiums this tight tell you retail demand is barely keeping pace with institutional NAV creation. No urgency, no panic, just equilibrium. The 5-day to 20-day volume ratio at 0.95x confirms it. Neutral flow, no net inflow, no exodus. Money isn't chasing semiconductors, it's parked. RSI at 41.9 and price below both the 20-day and 50-day moving averages? That's textbook bearish momentum, pure descriptive history. The chart isn't whispering. It's shouting that the last leg up is cooling. Now the narrative filter. Wall Street is selling SMH as a diversified tech play, but the macro headlines are screaming tariffs. 50% on Canada, stalled India deals, trade war déjà vu. Semiconductors are the most globalized supply chain on Earth. Every one of those tariffs lands directly on wafer fab equipment, substrate costs, or back-end packaging. The narrative that semiconductors are immune to trade policy is fiction. The one text signal that matters. Samsung just mass-produced the PM1763 SSD, optimized for AI infrastructure. That's Capex flowing into hyperscale data centers, not wearables or edge devices. SMH's weight in memory and storage? 18%. The fund is structurally underweight the exact segment where Capex is landing. VanEck's narrative of diversified tech exposure is a packaging lie. The lab's verdict. SMH is a trade war hostage with a Capex mismatch. The durable case for SMH rests on enterprise infrastructure demand driving the upcoming Nvidia Blackwell graphics chip launch. Hyperscale cloud providers continue building massive computing clusters, establishing this fund as the primary hardware shovel provider. Nvidia and Taiwan Semiconductor combined represent 26.9% of total asset exposure. That concentrated allocation ensures the fund directly captures maximum revenue expansion across high-performance silicon manufacturing. The primary threat to this thesis is regulatory and policy friction. Strict United States export controls on advanced artificial intelligence chips to China directly restrict revenue potential for key holdings. Furthermore, high interest rates make debt-financed capital expenditure for building expensive domestic fabrication facilities significantly more costly. A sudden reduction in cloud computing infrastructure spending would immediately impair hardware valuation multiples. Investors must monitor two core structural signals going forward. First, track cloud hyperscaler capital spending plans during upcoming corporate earnings reports. Second, monitor Taiwan's semiconductor fabrication capacity utilization and geopolitical supply chain stability in Taiwan. Because TSMC produces almost all advanced accelerators, any manufacturing disruption would instantly freeze global hardware delivery. The Fear and Greed Index sits at 33, indicating a broader fearful market backdrop. The lab rates SMH structure durability as none out of 100 under current evaluation metrics. Hyperscaler infrastructure capital expenditure trajectories remain the single decisive metric that will determine future fund stability. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70-30 with SCHD, you keep the sector upside while the dividend side, currently yielding 330%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. SMH move hides a 28-nanometer supply cliff no one's pricing in. What competitive risk deserves more attention in the SMH story? This isn't financial advice, just engineering-level analysis for education. Markets change. Past performance never guarantees future returns, and you should always run your own numbers before pulling the trigger. Subscribe so you don't miss Thursday's deep dive. We're tearing down SK Hynix. The lab's back with more. Stay sharp.